Good afternoon. This is now the third time I have tried to make this video today, having screwed up both prior attempts, with the last one getting all the way through to the end and realizing that accidentally, when I moved my microphone over, I accidentally hit the mute button. So my dad up in heaven is definitely having a good laugh because I used to always make fun of him for all of his technological deficiencies. Like, he would always type all his letters and emails in capitals and rarely use punctuation. And then he would always complain that the internet was broken when something didn't work. So now he's laughing because I did something similar. I mean, hitting the mute button is kind of embarrassing. Anyway, I want to do a quick video, maybe not so quick, and talk about the single most requested topic in a short period of time I've had in 31 years in business, and that is, how can the retail investor take advantage of negative oil prices? How can they somehow buy oil, get paid to buy oil, I guess? So the short answer is you cannot. In this video, I'm going to talk about the structure of oil and why what you heard in the media, which I would say is mass hysteria, is not really the case. Yes, oil is collapsing. Oil has been collapsing all year. It's been collapsing because perceived weak demand, number one. So the demand for oil has collapsed. Number two, it has also collapsed because there is an almost endless supply on the market today, which is, I don't know, ironic, polar opposite, however you want to, whatever you want to say. 12 years ago, in the middle of 2008, oil was on its way to $147 a barrel, 147. You could Google back then, everyone talked about peak oil. That was it. There wasn't enough oil left. There was nothing in storage tanks. We were really up the creek. Today, 12 years later, yesterday oil closed at negative $37 a barrel. And I think at one point it was at negative $43 a barrel. How's that possible? You have to understand how oil is structured. So oil is a commodity. It's not a stock. For every buyer in oil, there is a seller in oil, matched up. Hypothetically, in stocks, there could be only people who own IBM and nobody who's short IBM. In other words, no one looking for IBM to go down. In oil, you need someone to sell a contract and someone to buy a contract. Very different commodities from stocks. So like other commodities, oil's contract expires. Oil expires every month. So the May contract, which people buy and sell throughout the year, but really throughout the last month, expired today. May goes off the board today, and we begin trading the June contract. Every single month, the contract expires and a new month begins. You can go out and buy oil many months and quarters and even years into the future. Although the farther out you go, the less liquid that security is. But you can go out into the future and buy or sell oil. Now, what happened yesterday in the last couple of days? So there is very weak demand for oil. No one's buying it. And there is a huge glut on the market. We know that fateful day in March about a month ago, no, more than a month ago, where the Saudis and the Russians said, no deal, we're going to just flood the market with oil. They got into a spat, which we know, and they both would love to see the United States independent energy go away. So that was really the seminal moment where oil began to really unravel and crash. In any case, now we are at a point, or yesterday we were at a point where oil was at negative $37 a barrel. Had that happen, quite simply, the May contract was expiring. And as it expired, you had an awful lot of people who owned oil and wanted to take delivery. So at the end of the contract, of a commodities contract, you can opt to take delivery. You don't have to sell it in the market. Just say, I think one oil contract is either, I forgot, 42,000 barrels of oil or 78,000 barrels. It's a lot of oil. And I believe that oil sits in Houston, Galveston maybe, and you've got to go pick it up. That's what I believe. It could be Chicago for all I know. But in any case, a lot of people were looking to take delivery of oil. And what happened was storage for the oil became non-existent. There's no storage facilities left to store the oil. So at the end, people said, holy geez, the May contract is going away. It's going to expire. We better get out of this because we can't take delivery. There's nowhere to put it. So people are flooding the market with sell orders on oil. And there was no one there who really wanted to offset that. So the contract kept falling. We all know when crashes happen, there becomes dislocations. The system temporarily breaks and you get prices that don't make any intuitive sense. It's exactly what happened. Now, it wasn't across the board. I think the media did you a disservice by telling you oil was at negative $37 a barrel, because as that was happening, the June contract, which was being traded already as the primary contract, I'm looking over at my other screen, which I'll show you in a minute. The June contract was trading at yesterday roughly $21 a barrel. The July contract was trading at $25, $26 a barrel. August was 27, 28, and on and on. The farther out you went into the future, the higher oil went. And that's because there is a perception that oil will rebound. So those of you who have never traded a commodities contract, caveat emptor, buyer beware, when one contract expires and goes off the board, like May did, and the next one starts, there could be an enormous price difference. So you could hypothetically get out of your May oil at zero, for sake of argument. You sell it at zero, you're done. And then if you still want to own oil, the June contract could be trading at $20 a barrel. So you go off at zero, the next day it's at 20. Nobody makes the difference in that 0 to 20. It closes at zero. Next day, the June contract has already been trading, it's at 20 bucks. That's one of the structural problems if you buy or sell the oil ETF, exchange traded fund market, is that every month they have to roll oil forward from May to June and July. And in a normal oil market, farther out months are higher and higher and higher. So you kind of get ripped off a little bit. That's a structural flaw in all commodity exchange traded funds. Exchange traded funds do not work well for commodities. I will tell you that. If you want to trade them in a very short period of time, they're fine. The longer you own them, the more detrimental they are to your financial health. So be careful with owning the commodity related ETFs. Now I'm going to show you my screen. Okay. So this is the third time I'm pulling this up, and you will see in orange, here's the July oil contract, which is right now at $20, we'll call it 21 bucks. August is at 23, September is at 25, October is 26, November is 27, December is 28. I think you get the picture. The farther out you go, it's $1 more a barrel into the future. And that's how oil normally trades. If I'm going to use a technical term, it's called contango, C-O-N-T-A-N-G-O, contango. It means the first month is the lowest, and the farther out you go, the higher it gets. That's how normal oil trades. It doesn't normally trade, though, at zero or negative or even $1, $2, or $3 a barrel like we saw. But you're certainly seeing a crash right now. And even if the May contract didn't go to negative $43 a barrel, the June and July contract still went down significantly. I think if I'm looking correctly right now at my screen, June oil is still down more than 30% today. But yesterday, the May contract, I want to say they had it down 100 and something percent because obviously it went below zero. So just keep in mind, when you see crazy things like oil at negative or oil at zero, you as the average investor cannot take advantage of paying zero for oil or negative oil. That's part of how oil is structured, unless you plan on taking delivery of it, which I don't think anybody wants to own you at 42,000 or 78,000 barrels of oil. One thing to also note, during the day, and as I'm doing this video, it's after 3 o'clock Eastern time, and I didn't check in the last couple of minutes, but I will. The XOP, which is the oil and gas exploration ETF, for most of today, that was higher. That was up on the day. So you'd think if oil was that cheap and clearly below zero, drilling for oil, those kind of stocks would be hammered. They were up on the day. That tells me that the market dislocation is not being seen in the stocks. It also tells me that oil is close to bottoming. You wouldn't see the XOP up on the day with oil down 30% or even close to being up on the day if this market dislocation wasn't closer to the end than anything else. So I would subscribe, you're in that bottoming period for oil, whether that's yesterday, today, tomorrow, but in the next couple days to a week, we should see some kind of low form in oil. Are we going to go back to 100 anytime soon? I doubt it, but I would not start to believe that oil is going to trade in the single digits and clearly not below zero for long. What should you do as a consumer? So one, I would certainly call your oil company. So in our house, I use, we have an oil burner, which I don't use. I use pellets, we use a lot. And I have a propane insert in another fireplace. So I've got oil, propane, and pellets. I usually burn pellets. But because oil is now so cheap, I use a COD, cash on delivery oil company, which I've had wonderful success with. I don't know why you'd ever spend all that money using a full service oil company anymore, but to each his own. My COD company has offered to let me pre-buy oil for next winter. I want to say it was like $1.40 a gallon, maybe. So $1.40 a gallon, that's cheaper than me burning pellets. And I love to save some money, and I like to keep my house pretty warm because my hands and toes are always cold. Topic for a different day, or as my kids would say, Dad, TMI, too much information. So that's what you could or should be doing as a consumer. As an investor looking just at oil, you're going to be hard pressed to put on a trade that you'd be comfortable with. You can watch overnight some of the ETFs like USO, Uncle, Sam, Oscar, and UCO, Uncle, Charlie, Oscar. UCO is leveraged. So these ETFs have essentially broken, and my guess is they're fighting for their lives for survival right now. I think some of the companies that sponsor the ETFs literally overnight are going to have to restructure them because of this amazing dislocation. They can't continue. They're not functioning right now. So look for that to happen. UCO, the ETF, had a reverse split last night, meaning if you owned 10 shares and it split 1 for 10, you now only own 1 share, but they multiply the price by 10. When you have reverse splits, it happens normally after a long protracted decline. They typically come towards a low, towards the bottom, which I subscribe as we are getting close to right now. So I'm going to unshare my screen so you can see my big fat ugly mug. And that's it for this oil update. If you still have questions, please call me, email me, text me, tweet me, Facebook me. I'm happy to have a one-on-one discussion to make you understand or help you to understand what's going on with oil. On investfortomorrowblog.com, I wrote this up yesterday, investfortomorrowblog.com. Also, today I published a recurring piece regarding if you own an IRA and you're over 70 and a half, you do not have to take your required minimum distribution this year. Please, please, please. Another unintended benefit of the CARES Act. Finally, I'll leave you with this. If you're refinancing your mortgage, be caveat emptor, buyer beware. Mortgage rates, 15 and 30-year mortgage rates, are not moving lockstep with long-term interest rates as they normally do and have. There's a little disconnect. So be careful with free financing. Your fixed rate mortgage will likely be higher than you expect. Do your homework. Don't be in a hurry to lose your money. With that, I thank you for watching. Please feel free. You can email me, paul@investfortomorrow.com, and the rest is on the website, Invest for Tomorrow. Please stay safe and stay healthy.